So this is our first look at 2018 tax forms with all the changes with the Tax Cut and Jobs Act, TCJA, JA rather, um, or the Trump tax reform, whatever you want to call it. So here on the left, we have 2018 tax forms, which are still in draft mode, meaning the IRS has not approved these for final publication, but they're going to be close to what these are. They tend to make changes all throughout the year, but they'll release a final filing version when they open e-filing, which is usually end of January, and but then they'll make revisions, to various little tweaks here and there throughout the year. So this is not going to be the final version, but it's going to be something close to this. And for comparison, on the right, I put up 2017. And this is just kind of a generic pro forma kind of thing. These aren't actual people. These are not actual Social Security numbers. These are just, placeholders. So I just installed our 2018 tax software yesterday because it just became available. So in this case, what we're looking at is a married couple, Joe and Jane taxpayer. They have 2 kids, and both the kids are under 17. So they both qualify for the child tax credit, the additional child tax credit. And just as a number to pick, I put it in that they're making $50,000 a year. So if we look at the left side of the screen, we've got 2018. You can see it looks a lot different than this one. This is supposed to be theoretically a postcard size, and maybe in print it would be. It's basically half of an 8.5 by 11 sheet of paper. The top is your filer information. That's pretty much the same. Name, first name, last name, social security number, spouse, first name, last name, social security number, how you're filing, whether you're single, married separate, head of household, qualified widower. That was the same as this box here, laid out a little bit differently. Exemptions. So exemptions are gone. Those no longer exist. So that is one of those changes that the Tax Cut and Jobs Act made. So under the old system, which was 2017 and before, basically, you claimed an exemption, meaning that you were saying that this person is a resident of this tax household, and you got a certain exemption of income for that amount. So in 2017 taxes, you got $4,050 per, I think it's $4,050 $4,050 per person in the tax household. So in this family of 4, they had $16,200 of exemptions for 4 people, which reduced any taxable income by that amount. So that's sort of just a gimme for the IRS saying that, well, it does cost money just to live. So there's an exemption for that, which is roughly half to 2/3 of the federal poverty level for that family size. So that's gone, and in the new system, that was replaced by increasing the standard deduction, which was, for a married couple was $12,700, and also creating a tax, or increasing the tax credits for children and creating a tax credit for other dependents. So if you have, let's say, your brother is disabled and lives with you, then you get a $500 or up to a $500 credit for his presence in your tax household. If you're taking care of your elderly parents, same thing, $500 a person, and that's called the other dependents credit, which is a new thing. And so the front page of 2018 is just kind of a summary. Who you are, where you live, what kind of filing you have, who your kids are, and we have this new column, see credit for other dependents. So are they children or are they other? So up to $2,000, $500, and then sign and date, whatever. So when we go to page 2, we have what used to be over on page 1 down here. So we have the income section. So wages, interest. So taxable interest. So in the old form, they put them on different lines, 8A, 8B, and here they put them on the same line just to conserve space because they're under this mandate of making a postcard size. So interest, dividends, that follows the same. IRAs and pensions, so that was equivalent to lines 15 and 16 here. And Social Security benefits, that was line 20 on the old form. And then total income. So what we are not seeing is a bunch of these other lines. Taxable refunds, credits, or offsets of state and local income taxes, alimony received, business income, capital gains income, other gains, rental, real estate, royalties, partnerships, S corps, trusts, etc., farm income or loss, unemployment compensation, and other. So that is all now combined into a schedule. Where did it go? Schedule 1, which is basically all this stuff. So, and then scrolling down, we have this section of adjustments to gross income, which creates the adjusted gross income. And these are all, subtractions from this number. Educator expenses if you're a teacher, certain business expenses for reservists, performing artists, and fee-based government officials, health savings account deductions, moving expenses. Moving expenses are gone. And now moving expenses are counted only if you're a member of the armed forces and it wasn't paid for, stuff like that. So they've condensed, or not condensed, they've shifted these other lines of information to alternate schedules to save space and create this postcard size thing. So then we go down qualified business income deduction. So that is the 20% pass-through credit. Not a credit, it's a deduction. So, I've written a number of things about QBI. And the it's going to be interesting. So the idea is that they want to increase or support businesses, investment in businesses and all this kind of thing. So now with Schedule C, Schedule E, I think Schedule F will qualify. The amounts coming through that are positive are discounted 20%. So if you make, let's say you make a $50,000 salary and then you have a $100,000 pass-through profit from something or other, whether it's real estate or a business or something, then instead of being taxed on 150, you get a $20,000 deduction off that 100, so you're only being taxed on 130. And then subject to many limitations and qualifications and all that kind of stuff. So then we have taxable income, which is the total income minus deductions, and that leaves us the tax, which is $27.42 in this case, and then we have child tax credit or credit for other dependents, and any other amounts on Schedule 3. So if we go over there, let's look at Schedule 3. That corresponds to this section on the old forms: foreign tax credit, child dependent care expenses, education credits, retirement savings contribution credits, and so on. And then we are left with total tax, and then we get to other taxes, is all this other stuff. This section here goes on Schedule 4. You can see here, which is pretty much the same. And then we have total tax, which in this case is 0, and then refundable credits. So refundable credits is your stuff like your earned income credit, your additional child tax credit, your American Opportunity Credit, the refundable portion of that, and your payments that you already made, and all that kind of stuff. So that is kind of the summary. Schedule 5, we have more of this stuff down here. So what's interesting to me is that, the promise that you're going to have just a postcard size thing is only accomplished by ignoring all these schedules, which was basically all the same information you had before, but just on different pieces of paper. So, take that for what it's worth. Our standard deduction obviously changed quite a bit. Here we've got 24, here we've got 12.7, and if we actually look at what those are composed of, we see a couple more changes. So medical and dental, we have our 7.5% exclusion factor, which is the same, which is down from 10% under the Obamacare rules, so that was, I think, a good change. Then we have our taxes, our state and local taxes, whether it's income or sales tax, real estate tax, personal property taxes, and then other. But now we have this slide. Enter the smaller of line 5D and $10,000. $5,000 with married filing separate. So it's limiting your deductions for taxes you already paid to $10,000. Now, for the majority of people, that is not going to be that big a factor. But for those people living in high property tax states, or very high sales tax states, then, or very high income tax states, then you might be bumping into that limit. Because, so like in New Jersey, it's not that uncommon to have property taxes of, $10, $12, $20,000 a year. So those people are going to lose out on deductions that they had under the old system. Similarly, under the home mortgage stuff, the old limit for deductible interest was $1 million, and now it's $750. And so far, mortgage insurance premiums has not been addressed by the Congress. So that's one of those things they have to renew every year, saying, will it be deductible in this tax year or not? Right now, it is not. And that's probably what this space is reserved for. Then we go down to gift charity. That's pretty much the same. And then casualty and theft losses becomes casualty and theft losses from a federally declared disaster area. So under the old rules, let's say you had a pipe burst in your house, it flooded, and you had to spend $50,000 in renovations, because the insurance company wouldn't do whatever. So now those kinds of things only qualify if they are occurring in a federally declared disaster area. So in 2017 rather, we had Hurricane Irma here in Florida. So a lot of people had a lot of damage from that. Roofs, windows, trees knocked down, all that kind of stuff. Some flooding, depending on where you were. And those were all occurring in a federally declared disaster area. And Congress actually passed a special law just dealing with those. So Hurricane Irma, Hurricane Maria, and the one that hit Texas. Can't remember the name off the top of my head. But if you were in those areas affected by those hurricanes, then you got a special calculation of casualty losses. But people in Minnesota obviously weren't affected by those hurricanes. So if you were in Minnesota and you had some sort of property damage like that, you were able to deduct it. And under the new rules, you cannot. And then a lot of this stuff, job expenses and certain miscellaneous deductions, are more or less gone. So those changes and limitations, combined with the fact that the overall number is now higher, going from, for a married couple, 12.7 up to 24, the vast majority of people, I think, are not going to be able to itemize deductions. So that's going to be one form of simplification, I suppose. Also, tax rates have changed. You can see here, if you look up in the corner, for the same family, same numbers, in 2017, they would have owed $236 total. I mean, their withholding on the salary probably would have covered that, and they would have gotten a refund. But under the new rules, they're getting a refund of $1,258. So that is $1,500 less. And that's going to scale more or less on throughout income. So rates are lower, and higher income earners, they're going to have certain limits, but they always did. So that's going to scale along, and we have for those higher income earners, they're more likely to be business owners. So we have the qualified business income deduction, and so people are. It's kind of a double-edged sword here. So the filing season of 2018, I think, is going to be a disaster because all these forms are still in draft. It's today, November 27th, and I'm skeptical that the IRS will have everything ready on time for normal filing. I would not be surprised to see some people being pushed into, February, March, hopefully not April, before all the forms for their particular tax return are ready. We saw that a few years ago with business tax returns. Many of the forms were not available until March, and it just creates a giant pain for everybody involved. Taxpayers, people wanting their taxes done, people wanting refunds, So I'm expecting a similar kind of thing for this upcoming tax filing season. But who knows? Maybe the IRS will get on the ball and get everything ready on time. Fingers crossed. But that is our quick look at 2018's tax paperwork. So if there are any major changes, I'll make another video and we'll see how it goes.